Welcome back, Focus Learners. Let's just jump right in today. We are popping the hood on one of the most fascinating mechanisms out there, the macroeconomic engine. We're decoding the exact blueprint laid out in N. Gregory Mankiw's Principles of Economics, specifically Chapter 32. If you've ever wondered how government deficits in one country can literally alter the price of a passenger jet in another, well, you're in the right place. In this explainer, we're going to map out exactly how all these gears interlock. Here is our roadmap for today. First, we'll outline the open economy blueprint. Then, we'll dive into the market for loanable funds and the foreign currency exchange. After that, we'll look at the crucial link tying it all together, NCO. And finally, we'll run 2 live simulations, budget deficits and import quotas.
Section 1. The Open Economy Blueprint.
All right, let's get into it. You know, for a long time in macroeconomics, it's just easier to assume we're working with a closed economy, a closed system that doesn't interact with the outside world. And hey, that's a really useful simplification for learning the ropes. But unless we're talking about the entire global economy, and we still don't have interplanetary trade, it's just not reality. The real world is an open economy. It interacts freely in world markets, constantly buying and selling goods, services, and capital assets on a massive global scale. Now, every system has source code, right? And for the open economy, it's built on these 2 incredibly powerful governing identities. The first one is S equals I plus NCO. That basically means every single dollar of national saving must be used for either domestic investment, like building a factory, or for net capital outflow, which means buying assets abroad. The second identity is NCO equals NX. Net capital outflow always perfectly equals net exports. The big takeaway here? Every single dollar flowing through our international markets has to be mathematically accounted for within these 2 equations, no exception. Section 2, Market for Loanable Funds. Think of this market as the grand coordinator of all domestic wealth. The supply of loanable funds comes entirely from national saving. You save a buck, it ends up here. But the demand? It's twofold. It comes from folks wanting to fund domestic investment, plus those seeking net capital outflow to buy foreign assets. And the automatic stabilizer balancing all this out? The real interest rate. When demand is super high, the interest rate just rises to cool things down. Simple as that. Section 3. Foreign currency exchange. Now, this market coordinates the actual trading of the currencies themselves. Over here, the supply of dollars comes from net capital outflow. So Americans supplying dollars because they want to buy foreign assets. The demand for those dollars comes from net exports. That's foreigners who need dollars to buy U.S. stuff, like planes, wheat, or software. And the balancing force that scales up or down to keep supply and demand perfectly matched, that would be the real exchange rate.
Section 4. The Crucial Link, NCO.
When you look at these 2 markets side by side, something truly fascinating pops out. Look right at net capital outflow, or NCO. It's this brilliant design feature linking the 2 systems together. In the loanable funds market, NCO is a piece of the demand for money. But over in the foreign currency exchange market, NCO acts as the supply of dollars. It's literally the exact same variable acting as a bridge between domestic finance and international trade. And the way this bridge behaves is pretty predictable. There's a clear inverse relationship. When the domestic real interest rate climbs upward, domestic assets suddenly look a lot more attractive to investors. Because of that, fewer people want to send their money overseas, which causes net capital outflow to shrink. Now, I should also mention, political instability can throw a massive wrench into this. If people lose faith in a country's government, you get what's called capital flight, triggering a huge, sudden spike in capital flowing out, completely ignoring the interest rate. But barring any sudden shocks like that, keep this standard interest rate dynamic in mind as we run our simulations.
Section 5. Simulation 1. Budget deficits.
Okay, let's watch the cascade effect step by step. Step 1. The government spends more than it takes in, meaning they run a budget deficit. Step 2. Because public saving is now negative, total national saving drops. That instantly reduces the supply of loanable funds. Step 3. To balance this newly reduced supply against the existing demand, the real interest rate is forced to rise, meaning the cost of borrowing just got a whole lot more expensive for everyone. So how does this ripple across our bridge? Well, because the domestic interest rate is now higher, net capital outflow shrinks. Fewer people are investing abroad. That's step 1. Step 2, that reduced NCO means there's suddenly a lower supply of dollars floating around in the foreign currency exchange market. Step 3, this scarcity causes the real exchange rate to appreciate, the dollar gets stronger. And finally, step 4, because the dollar is stronger, domestic goods are now way more expensive for foreigners to buy. That inevitably pushes the overall trade balance straight toward a deficit. So, to summarize our first simulation, When a government runs a budget deficit, it sets off a massive chain reaction. It raises real interest rates, which crowds out domestic investment. That higher rate causes the currency to appreciate, which then pushes the trade balance toward a deficit. It's an absolutely flawless, interconnected macroeconomic feedback loop. Section 6. Simulation 2. Import quotas.
Let's reboot the system and trace a completely different data stream. What happens if a government applies a direct trade policy, like slapping a quota on imported cars? Step 1. The import quota artificially restricts foreign goods coming in, meaning net exports initially try to rise. Step 2. Because foreigners still want our domestic goods, but they're selling less to us, the demand for dollars in the exchange market surges. Step 3. This massive surge causes the real exchange rate to appreciate significantly. Step 4. This newly strengthened dollar makes all our other exports more expensive for the rest of the world and makes non-quota imports cheaper for us. And here's the wild part. Keep in mind, absolutely none of this altered national saving or the loanable funds market. NCO didn't budge. If you map out the mechanics of an import quota across these markets, you'll see the market for loanable funds is totally untouched. Net capital outflow remains exactly the same. But over in the foreign exchange market, the demand for dollars shifts way out, driving the exchange rate higher. So that initial artificial spike in net exports from the quota, it is completely and perfectly neutralized by the appreciation of the currency. And that brings us to this incredibly counterintuitive punchline right from our source material. In the end, an import quota reduces both imports and exports, but net exports are unchanged. That's right. The policy might save a few jobs at a domestic car company, but because the stronger dollar makes airplanes harder to sell abroad, it ends up hurting domestic exporters like Boeing. The overall macro balance, it literally does not move an inch.
So what should you really take away from this explainer? It's the beautiful, ruthless interconnectedness of the open economy engine. Manipulating one lever is always going to move another. We've seen that direct trade policies, like tariffs and quotas, don't actually fix a trade deficit. They merely shift the winners and losers around within specific domestic industries, completely leaving the big picture unchanged. Which leaves us with a really fascinating puzzle to ponder as we wrap up. If slapping quotas or tariffs on foreign goods mathematically cannot change the overall trade balance, what fundamental domestic levers must a country actually pull to reverse a trade deficit? I highly encourage you to look back at our very first simulation for the real answer. Thanks so much for engaging with this explainer, and stay focused until next time.